Hello investors and traders. This video will explain the strategy of Stochastic Oscillator Indicator and Stochastic Oscillator Index. You know the catchphrase, study it, analyze it, adapt it. What is the Stochastic Oscillator Indicator? A stochastic oscillator is a momentum indicator comparing a particular closing price of a security to a range of its prices over a certain period of time. The sensitivity of the oscillator to market movements is reducible by adjusting that time period or by taking a moving average of the result. It is used to generate overbought and oversold trading signals, utilizing a 0 to 100 bounded range of values. Stochastic oscillator is a popular technical indicator for generating overbought and oversold signals. It's a popular momentum indicator first developed in the 1950s. Stochastic oscillators tend to vary around some mean price level since they rely on an asset's price history. The general theory serving as the foundation for this indicator is that in a market trending upwards, prices will close near the high, and in a market trending downward, prices close near the low. Transaction signals are created when the percentage K crosses through a 3-period moving average, which is called the percentage D. The difference between the slow and the fast stochastic oscillator is the slow percentage K incorporates a percentage K slowing period of 3 that controls the internal smoothing of percentage K. Setting the smoothing period to 1 is equivalent to plotting the fast stochastic oscillator. A brief history. The stochastic oscillator was developed in the late 1950s by George Lane. As designed by Lane, the stochastic oscillator presents the location of the closing price of a stock in relation to the high and low range of the price of a stock over a period of time, typically 14-day period. Lane, over the course of numerous interviews, has said the stochastic oscillator does not follow price or volume or anything similar. He indicates the oscillator follows the speed or momentum of price. Lane also reveals in interviews that as a rule the momentum or speed of the price of stock changes before the price itself. In this way, the stochastic oscillator can be used to foreshadow reversals when the indicator reveals bullish or bearish divergences. The signal is the first and arguably the most important trading signal Lane identified. What does the stochastic oscillator tell you? The stochastic oscillator is a range-bound, meaning it is always between 0 and 100. This makes it a useful indicator of overbought and oversold conditions. Traditional readings of over 80 are considered in the overbought range, and readings under 20 are considered oversold. However, these are not always indicative of impending reversals. Very strong trends can maintain overbought or oversold conditions for an extended period. Instead, traders should look to changes in the stochastic oscillator for clues about the future trend shifts. Stochastic oscillator charting generally consists of two lines, one reflecting the actual value of the oscillator for each session and one reflecting its 3-day simple moving average. Because price is thought to follow momentum, the intersection of these two lines is considered to be a signal that a reversal may be in the works, as indicates a large shift in momentum from day to day. Divergence between the stochastic oscillator and the trending price action is also seen as an important reversal sign. Example, when a bearish trend reaches a new lower low, but the oscillator prints a higher low, it may be an indicator that bears are exhausting their momentum and a bullish reversal is brewing. How do we use the stochastic oscillator in trading, in investing? Stochastic measures the momentum of price. If you visualize a rocket going up in the air, before it can turn, it must slow down. Momentum always changes direction before price. This is a quote from George Lane. So let's start at the beginning. For now, I'm going to tell you the reason why to throw out all the short positions, but let's just worry about getting an entry position in now. And how do we use the stochastic oscillator by itself, only going long? And I will explain the reason why we're only going long on these charts later on. You see down here, it's becoming oversold at this level. It's hitting sometimes yearly lows, oversold levels. And then you see a crossing point here. The fast stochastic crossing the slow stochastic, which thus off to the races. Boom. Now, we'll get into it a little bit later on, but I don't pay attention to the overbought levels as so much because we are in a bull market. Let's go to another one. A short one here. Just saying to add the positions in. It goes low here, crosses, off to the races. This was the QQQs. Let's go to the spiders, and let's move it back to a different time frame. Get it over here. Oversold levels, crosses, off to the races. Throw out all the shorting or the selling positions up here, and then you get another chance here to re-enter. Crossing goes up. Okay, let's look at another position, Tesla. Let's go back a little bit over here. And if you see over here, oversold conditions, throw out the getting out and short positions because we are in a bull run on Tesla. And again, each time we get a crossing point, an oversold position and a crossing point, we get an opportunity to make money on this stock. So if you back test the stochastic oscillator in a bull market, only the long sides, every time it crosses, it is a good entry point to get in. Stochastic Oscillator Indicator. Rule 1, follow top-down approach. The top-down approach to investing focuses on the big picture or how the overall market is trending. If the overall market is doing well, chances are the stochastic oscillator indicator will also do well. What's the trend of the market? If it's negative, you'll want to do very little buying, even if you see some stocks breaking out. Your probabilities of success are quite low when the market trend is against you. On the other hand, if the market is doing well, this combination of indicators, back tested, has amazing results. It is obvious from our whole system, understanding if we are in a bear market or in a bull market, a lot of these indicators work much better if you predict, if you know the probabilities of the overall market. So for this case study, we will assume the overall market is bullish. But remember, we could be in a bear market. If in a bear market, in a real market investing, use the opposite rules that I am telling you here today. Rule 2, under 20 are considered oversold. If the stochastic oscillator falls below 20 or below, and it has a near time low, a yearly low, a multi-year low, or an extreme low, this is a trigger to look at. This is a sign that we possibly could be buying. It is not ultimately when to buy there. It's just telling us that we are at oversold levels. Now, throughout history, I have seen oversold levels become even more oversold, which brings us to rule 3. The intersection of the two lines is considered to be a signal that a reversal is in the works, as it indicates a large shift in momentum from day to day. So from rule 2, we fall below the 20. Then we have an intersection of the two lines, which tells us we are off to the races. This is on a bull market, not a bear market, and we are at oversold levels. Let's go over a little bit how to exit a trade, protect the profit. The increased volatility in the stock market is a two-edged sword. On the positive side, it gives us a chance to make money even faster. The downside is when a reversal occurs, your stock can drop more quickly. The exit strategy will keep your decision-making simple, objective, and unemotional. You also won't have to constantly rethink whether it's time to lock in your profits or cut your losses short. The simplification, the selling process is more important than ever with the market becoming increasingly volatile. You don't want to suddenly sell a perfectly fine uptrending stock because of a whim. In the more likely and happy circumstances that your stock starts to move higher, here's what to do. As long as the stock is above its 200-day moving average and the moving average is rising in an uptrend fashion, be sure to give it plenty of room to gyrate with using ATR stop loss. We are going to trail the sell stop behind the advancing price to lock in the profit, yet let it run. Risk management. The first thing any good trader or investor should do is realize that they must never hold any position without a protective stop loss. These issues can really change direction in a hurry when bad news comes out and the institutional herd starts to panic. The way to protect yourself is by using stop orders. Using sell stops results in a minimum of emotion and misgivings. Best of all, there will be no gut-wrenching decision making. So here's a small system, a small way that you can make money now with the Stochastic Oscillator indicator. Become an expert on the top-down approach. What is the macro picture? The macro is bullish. We pull back to an oversold level of 20 and under. The two lines intersect. We protect our profits with using ATR for the volatility. And then, of course, we have stop losses for the occasions that we are incorrect. This is a great system, Stochastic Oscillator indicator. This is one of our 50 indicators we use to tell us which stock to get into, the macro picture. Let's continue. Another stochastic oscillator is the Stochastic Momentum Index. The rules is as follows. This goes into a range of usually minus 50 to 50, maybe a little above, maybe a little bit below. When it goes to minus 50 and below, it is considered oversold. When it goes to above positive 50, it is overbought. When you get a crossing point, it is a trigger to get in. So let's go and look at the overall market. The overall market is positive. The Stochastic Momentum Index drops to lower levels, yearly lows, or multi-year lows. If we wait for the SMI reading that falls to a recent low, then we're going to look for a reversal trade in the opposite direction. Just because it fell to a recent low does not mean we buy, but is an indication we could buy soon if other factors happen. So the SMI is get ready to buy signal. So the SMI falls to low levels, multi-year lows or lower lows, then we proceed for a buy signal. Look at these levels over here. SMI falls, SMI falls. Let's go back a little bit. SMI falls. All these times that the SMI fell, it would give us a signal to buy. I showed you the easy ones. Sometimes there's a double SMI over here, double falling below 50. Not a problem at all. Let's go further. SMI crossing point is more of an oscillator identifying key turning points. It does an excellent job at high points and lower points, but does not do a good job in a narrow range, and it does not do a good job fighting the overall trend. When you get a buy signal for the SMI crossing, it is time to enter. Sometimes I like to see a close above a day or a few day high for further confirmation. So let's just take that system. SMI, lower, crossing, break off. Let's continue to another one. This one's a little bit more difficult. SMI, low, low, crossing, but had another further low, and then bang, off to the races. So this one had a double dip. Let's go to this one. Excellent time period. Go to this one. It works very well. The best results are, as usual, the initial breakout, usually the first breakout being the strongest. Another indication that we look for is SMI, the histogram positive. Once the SMI crosses above the zero line to the positive, it is further confirmation of the entry signal buy. SMI above zero indicates price is above historic average. When trading above zero, the current price, it's above its historical average. An emerging bullish trend will be going from negative or near zero readings or under zero readings, under 50 readings, to above 0 to 50 readings can be used as a signal of an uptrend. Trading above 0 shows the uptrend is still going. One of my long-term indicators is to see if the SMI is still positive. So SMI turning positive on a histogram is further confirmation of the buy signal. Best results stay above 0 to 100, confirming a bullish trend. During a strong uptrend, the CCI will typically remain above the 0 line, above the 50 line. Staying at higher level confirms the strong trend and staying away from the below 0 ratings. Let's look at it. Over here, you can see the strong trend. Above 0, above 0, above 0, above 0. Again, another indicator. Key takeaways. As usual, one indicator does not make a strategy and should be coupled with other indicators and philosophies. The top-down analysis would be the first strategy you would use. Then the stochastic oscillators could be a great second move. Some people also add for the trigger point a MACD. Do not blindly trade overbought and oversold signals. Something overbought can stay overbought a long time. Something oversold can stay oversold even a longer time. So just because these indicators show an overbought level or an oversold level, it could stay that way for a long time. Time when a pullback will end. Find a good entry trigger signal. The stochastic oscillator formula works best in consistent trading ranges. Also, when you know the primary move of the market. The primary limitation of this indicator is that it has been known to produce fake false signals. This is when a trading signal is generated by the indicator, yet the price does not actually follow through, which can end up as a losing trade. During volatile trending market conditions, this can happen quite regularly. One way to help with this is to take the price trend as a filter where the signals are only taken if they are in the same direction as the trend. I am positive on the stochastic oscillator indicator, on the stochastic momentum indicator. Great indicator when used properly. So you know the catchphrase. Study it, analyze it, adapt it. Peace.